All right, let's get right into it. If you've been trying to figure out exactly where the smart money is flowing right now, you are in the perfect place. Today, we're diving into a pretty brutal data-driven reality, the massive capital rotation away from the Magnificent Seven in the first half of 2026. This is one of those defining moments in financial history where we absolutely have to look past the hype and let the data tell the story.
So, you've probably been pondering a very specific question lately. Why did the market act so incredibly weird? Honestly, if you felt a bizarre turbulence in the first half of the year, trust me, you are not alone. The tech titans, the companies that have literally dominated and ruled the markets for years, suddenly lost their shine. It was a totally bizarre dynamic. But let's be crystal clear right out of the gate, this is not the death of AI. Not even close. What we're actually looking at is a massive, highly calculated shift in where the money is flowing.
Section 1. The Market Mystery. A Shift in Capital.
Okay, so Goldman Sachs has pinpointed a fundamental paradigm shift. Think of it like this. The market used to reward companies simply for buying into AI dreams, right? You pitch a vision, you get the capital. Well, that patience has completely evaporated. The capital strategy has flipped 180 degrees. Now, investors are exclusively rewarding the infrastructure companies that are generating actual, tangible earnings today.
Section 2. The Fall from the AI Throne. The Cost of Supremacy.
To really grasp this fall from grace, we have to talk about the hyperscalers. We're talking about the absolute giants here: Google, Meta, Microsoft, and Amazon. In their ruthless fight for AI supremacy, they poured hundreds of billions of dollars into building out these massive data centers. They went all in. But that astronomical spending didn't just drain their bank accounts, it fundamentally shattered the supply chain, causing a critical market shortage of key physical components, specifically memory and storage.
So the crucial breaking point really comes down to three things. First, those massive data center expenditures. Second, because of that breakneck expansion, we hit critical component shortages. And third, and honestly, this is the catalyst for the entire market rotation, intense investor demand for immediate impressive margins. Investors are finally stepping back and actively questioning the sustainability of these massive investments. If these giants cannot deliver the immediate profit margins to justify the billions they're burning through, the market is simply no longer willing to give them a free pass.
Section 3. The Infrastructure Boom in Numbers. Following the Money.
Let's actually look at the data to anchor this analysis. Take the Roundhill Magnificent 7 ETF, or MAGS. Believe it or not, it actually experienced a slight downward trend for the first half of 2026. This ETF, which tracks the previously untouchable tech titans, experienced a very real, measurable decline. They are actively struggling under the massive weight of their own spending.
But while the tech giants stumbled, the chip makers, they absolutely struck gold. Just look at the numbers. The growth in the first half of 2026 is staggering. The VanEck Semiconductor ETF jumped 72%. The iShares Semiconductor ETF rocketed up 99%. And get this, the Roundhill Memory ETF literally doubled its value with 100% growth. This is the pure, unadulterated flow of capital straight into the pockets of the infrastructure providers who are bringing in real cash from the AI boom.
Section 4. Hidden Macroeconomic Risks, the War Room View. Now we have to zoom out for a second, because this snapshot of H1 2026 exists within a highly precarious period of macroeconomic adjustment, and the massive elephant in the room is hidden within private credit. In the context of this AI boom, private credit represents massive off-balance sheet funding. It is the invisible fuel pouring onto the fire of this growth. But because it operates completely outside of official balance sheets, it creates deep systemic vulnerabilities. Any tightening of interest rates makes this hidden debt wildly vulnerable, literally threatening to pull the rug right out from under the entire sector.
Which brings us to a really stark reminder from our previous reporting, the Q3 2026 market reset. Think about it. When you combine the staggering scale of a $25 trillion AI bubble with the high levels of hidden debt we just talked about, the stakes change entirely. High debt levels transform what would normally be just a standard market correction into a very severe risk of systemic liquidation.
Section 5. H2 2026 Expectations. Navigating the Unknowns.
Moving forward, this massive boom is staring down two distinct critical obstacles. On one side, cooling consumer demand. The data already points specifically to retail giants like Walmart seeing a slowdown. It is an economic inevitability that if consumer demand continues to cool on Main Street, that pressure will eventually travel up the chain and severely amplify the pressure on the tech sector. On the flip side, systemic liquidation risk due to high AI debt. If the consumer cools and revenues dip, this highly leveraged, debt-fueled AI infrastructure becomes incredibly fragile.
These dual threats are absolutely going to dictate the months ahead.
Actually, the ultimate takeaway here is perfectly summarized by a recent insight from Goldman Sachs. They stated, the rotation to semiconductors will continue only if hyperscalers surprise with exceptional results. That is the vital condition. The infrastructure boom only survives if the giants buying all the infrastructure can finally prove their worth. In a market balanced on this kind of razor's edge, your only real defense is strict discipline. You have to keep a relentless eye on cash reserves and liquidity.
The reality of this market is shifting under our feet right now, leaving us with one incredibly vital question. Are you ready for the second half of 26? We've looked at the hard numbers, we've tracked the brutal capital rotation, and we've mapped out the macro risks. Navigating the rest of this year is going to require absolute total focus. Keep your eyes on the data and stay prepared.